Look at the date on your screen and let it sink in. This is not a normal trading day. This is Wednesday, December 31st, 2025, and we are standing inside the final 36 hours before the global silver market changes forever. In just a day and a half, the sun will rise on January 2nd, the holidays will be over, and China's export ban will become active law. But here is the part most people are missing. The event has not started yet on paper, but it is already detonated in reality. Markets do not wait for headlines. They front-run them, and right now the front run has turned into a fracture. For the last 48 hours, we have warned you about a bifurcation, a clean split between paper prices and physical reality. Today, that split is no longer theoretical. It has widened into a chasm so deep that price discovery itself has failed. As I speak to you right now, there is no longer a single global price for silver. There are multiple realities coexisting at the same time. And most investors are staring at the wrong one. The number on your banking app, the ticker on financial television that is not a signal anymore, it is a ghost. What we are witnessing is the collapse of a unified market into tiers, each revealing a different level of stress and truth. One tier is driven by panic, another by honest physical scarcity, and the last by pure paper inertia. This is what happens when a system built on leverage collides with a hard deadline and a physical constraint. The laws of finance can be bent for decades, but the laws of supply and demand always collect their debt in the end. This is not about charts, indicators, or short-term speculation anymore. This is about possession versus promises. It is about who controls the metal when borders close and licenses go dark. Over the next chapters, I'm going to walk you through exactly how this fracture formed, why arbitrage is dead, why delivery demand has exploded, and why the price you see is no longer the price that matters. The countdown is not to a future event. The countdown is to recognition. If this analysis is helping you see what most people still can't, type 1 in the comments and make sure you are subscribed so you don't miss the next chapter. If you want me to stop here, type 2. To understand how deep this fracture goes, we have to dismantle the illusion of a single silver price. What exists now is a 3-tier market, and each tier tells a very different story about fear, scarcity, and control. If you are only watching one of them, you are blind to the real signal. Tier 1 is the panic price. This is the price being paid in Shanghai, the manufacturing heart of the world. As the final trading session of the year closed, silver in Shanghai was trading at the equivalent of $84 and change. This is not speculative money. This is not hedge funds chasing momentum. This is the price paid by factories, refiners, and strategic buyers who actually consume the metal. They are not guessing. They are reacting. They see the export ban clock ticking down, and they are paying whatever it takes to secure inventory before the door slams shut. Tier 2 is the physical price outside the blast zone. In places like the Middle East and real physical markets where metal changes hands, silver is trading just under $80. This market is tense but rational. It is not in full panic yet, but it is demanding a premium. It is quietly confirming that physical silver is already worth far more than the paper quote. This tier is important because it proves the problem is not just China, scarcity is global. Then we arrive at Tier 3, the most dangerous one of all, the zombie price. This is the paper price in New York, hovering in the low 70s. This number looks calm, it looks stable. And that is exactly why it is so deceptive. The spread between Shanghai and New York is now more than $12, a gap so large it should not exist in a functioning global market. In a healthy system, that spread would be erased instantly by arbitrage. Traders would buy low and sell high until the prices converged. But they are not doing that because they can't. The metal cannot move. The deadline is too close. The bridge between paper and physical has already burned. What you are seeing on the screen is not a price. It is a delayed echo from a market that has lost control. A $12 spread on a global commodity is not just unusual, it is a declaration of failure. Silver is fungible. An ounce in New York is supposed to be interchangeable with an ounce in Shanghai. The entire architecture of modern commodity markets is built on that assumption. When that assumption breaks, everything built on top of it starts to wobble. In a normal world, this gap would trigger a feeding frenzy. Banks, hedge funds, and trading houses exist for one reason: to exploit inefficiencies like this. If arbitrage were alive, they would be buying every available ounce in New York and shipping it east, locking in risk-free profits measured in billions. The fact that this is not happening tells you everything you need to know. Arbitrage is dead because movement is dead. The traders know the clock better than anyone. They understand logistics, customs, shipping schedules, and regulatory choke points. They know that even if they bought silver in New York today, there is no physical path to land that metal in China before the export licenses go live. January 2nd is a hard wall. No amount of leverage can punch through it. So instead of closing the gap, the market is watching it widen in real time. This is how New York became an island. It is a paper island surrounded by a sea of physical shortage. Contracts are still trading, algorithms are still firing, but nobody wants to take delivery on the other side. When you see the paper price sitting calmly in the low 70s, understand what it represents. It is the price of a promise that most participants no longer trust. The real economy has already voted. Factories, energy producers, and strategic buyers are not negotiating with spreadsheets. They are securing atoms. And while the physical world reprices upward, the paper market lags behind, frozen by its own structure. This is why the spread is not closing. It is why it is accelerating. The market is no longer unified enough to heal itself. Price is only half the story. The other half is volume. And this is where the situation turns from alarming to explosive. While the paper price drifted, something far more important happened beneath the surface. Delivery demand didn't rise. It went vertical. Just one day ago, the physical delivery numbers were almost laughable. Out of billions of paper ounces traded, barely a handful of contracts actually stood for delivery. It was the perfect symbol of a speculative market, all leverage and no intent. But today that illusion collapsed in a single session. Nearly 2,000 contracts suddenly demanded physical settlement. That is over 9 million ounces of silver requested in one day. This was not a gradual increase. It was a coordinated rush. Thousands of large players looked at the calendar, saw the same deadline approaching, and made the same decision at the same time. They stopped rolling contracts forward. They stopped trusting paper exposure. They hit the delivery button. This is the moment when a paper market panics. Delivery is the one thing it cannot fake. When a system designed for speculation is forced to perform like a warehouse, it breaks. A 26-fold spike in delivery demand is not normal market behavior. It is a raid on the vault. It is the system trying to correct years of imbalance in 48 hours. Imagine being the institution on the other side of that trade. You sold a contract assuming it would be rolled as it always was. Suddenly the buyer wants bars, not dollars. You now have to source millions of ounces in a market where physical supply is vanishing and premiums are exploding. This is how liquidity disappears overnight. This delivery shock is the pressure point. It drains inventories, exposes leverage, and forces banks to scramble for cash. It is not noise. It is the sound of a market realizing that time has run out. When physical delivery surges at this scale, the damage doesn't stay confined to the commodity pit. It ripples straight into the banking system. This is where the story leaves price charts and enters balance sheets, and the evidence here is far more disturbing. To settle those delivery demands, banks have only two options. They either hand over metal from their own vaults, which are already thin, or they rush into the open market to buy silver at any price necessary. Both options are catastrophic. Draining vaults leaves them defenseless heading into the export ban. Buying in the open market forces them to pay premiums far above the paper price they sold at, locking in immediate losses on every ounce. This is how a liquidity spiral begins. Losses consume cash. Cash shortages force emergency borrowing, and that is exactly what we saw unfold over the last 48 hours. While the public was focused on holiday headlines, the Federal Reserve quietly injected billions into the banking system through emergency repo operations, not once, but twice. Nearly $6 billion of overnight liquidity was pumped into the system in 2 days. That is not routine, that is triage. Banks do not beg for cash on New Year's Eve unless something is badly wrong. This money wasn't used to expand lending or stimulate growth. It was burned to keep the plumbing from freezing while delivery obligations were being met. This is the hidden cost of price suppression. Every dollar injected is a subsidy to a broken structure paying the difference between fantasy prices and physical reality. It buys time, not solutions. And time is the one thing the system no longer has. The liquidity injection is not a sign of strength. It is proof that the pressure has reached the core. While Western banks were desperately scrambling for dollars, the real crisis was unfolding thousands of miles away, quietly and relentlessly inside the vaults of Shanghai. This is where the story stops being about sentiment and starts becoming about arithmetic. And arithmetic has no mercy. In just 48 hours, more than 80 metric tons of silver were withdrawn from the Shanghai exchange. Let that number sit with you for a moment. This is not a spike in normal industrial demand. Under healthy market conditions, Shanghai typically sees withdrawals of 2, maybe 3 tons per day. What we are witnessing now is over 40 tons per day. That is not consumption. That is liquidation of inventory at emergency speed. This behavior only appears when participants believe future access will be cut off. Buyers are no longer optimizing price. They are optimizing survival. They are pulling metal, not because it is cheap, but because it may soon be unavailable at any price. That distinction matters. Once a market crosses from price sensitivity to availability panic, the entire structure changes. At the current withdrawal rate, several percent of the total registered inventory is disappearing every single day. Inventories do not glide toward zero. They snap. When stockpiles fall below critical psychological thresholds, buyers do not slow down. They double their orders. Fear feeds on itself. The curve goes exponential. And here is the most important part. This drain is irreversible. Every ounce removed from Shanghai is an ounce that will never be used to rebalance global prices. It cannot be shipped back west. It cannot be rehypothecated. It is locked behind policy strategy and national interest. This is why the Shanghai price is not reacting to New York. It is ignoring it. You can inject billions to save a bank. You can suspend rules to save a market, but you cannot conjure 80 tons of silver out of thin air. The depletion math alone tells us this system cannot stabilize. It must break, and it will break where reality lives. What begins in vaults never stays in vaults. Scarcity always migrates downstream, and now it has reached the factory floor. This is the moment when theory turns into boardroom reality, and it is the most dangerous phase of all. For decades, global manufacturing has been built on a single assumption: just-in-time delivery. Companies minimized inventory, maximized efficiency, and trusted that raw materials would always be available when needed. That assumption just collapsed. When supply chains fracture just in time becomes not in time, and the consequences are immediate. The world's largest industrial consumers of silver are no longer behaving like price takers. They are behaving like survivalists. We are seeing emergency procurement orders that would have been unthinkable weeks ago. Corporations that typically hold days or weeks of inventory are now trying to secure months of supply in advance. This is not speculation. This is continuity planning. For these companies, the price of silver is almost irrelevant. Silver represents a tiny fraction of the cost of an electronic device, a solar panel, or a battery system. But without it, production stops entirely. Paying a premium is survivable. A shutdown is not. That is why bids are rising without hesitation. This industrial panic creates a self-reinforcing loop. Every large buyer who hoards supply removes metal from the open market, tightening availability for the next buyer. That buyer then responds by hoarding even more aggressively. The result is a cascading demand shock that no paper mechanism can absorb. At this stage, the market is no longer being driven by traders or speculators. It is being driven by engineers, procurement officers, and executives staring at production schedules. When factories need metal, contracts become meaningless. They will outbid each other in the shadows off exchange, away from screens, and those prices will never show up on a chart. This is how a commodity leaves the financial system and re-enters the real economy, and once that happens, paper loses its power. While industrial giants were quietly securing supply behind closed doors, the signal became impossible to ignore on Main Street. This is where the paper price finally loses all credibility because reality starts demanding cash, not contracts. If silver were truly trading in the low 70s, you would be able to buy it at that price. Try it. Walk into a local coin shop or open a major online dealer's website and attempt to purchase physical silver at the so-called spot price. You can't. What you will see instead are premiums that have exploded into double digits. Government-minted coins, which normally carry modest premiums, are now priced more than $10 above spot. Even generic rounds, the lowest tier of physical silver, are commanding premiums that would have been considered impossible in a stable market. Dealers are not being greedy. They are being honest. They know replacement costs are rising faster than screens can update. This is the street price revolt. It is the physical market openly rejecting the number printed on financial terminals. Dealers understand a simple truth: if they sell inventory today at paper prices, they may not be able to replace it tomorrow at any price. So they price in the future shortage. They price in risk. They price in reality. Supply chains behind the dealers are freezing. Wholesalers are pulling inventory. Mints are falling behind. Delivery timelines are stretching from days to weeks, and those delays are a warning signal. When a dealer says 6 weeks, it usually means the metal is not there. It means the system is gridlocked. This is the final confirmation. When factories, vaults, and storefronts all converge on the same higher price, the spot price becomes irrelevant. It turns into a historical artifact, a number that exists only on a screen detached from the act of buying and selling real metal. Now we stop looking backward and start looking forward, because what matters most is not what just happened, but what happens next. We are inside the most dangerous 36 hours the silver market has ever faced, and the sequence from here is disturbingly clear. Phase 1 is the last window. As markets approach the holiday close, liquidity thins and desperation rises. This is the final opportunity for paper shorts to adjust positions before the rules change. You may see violent price swings, sharp drops meant to shake confidence, or sudden spikes as some players capitulate. None of it changes the outcome. At this stage, price volatility is noise. Possession is the signal. Once the closing bell rings, we enter phase 2, the void. Screens go dark, markets close, but stress does not pause. This is when emergency meetings happen. Risk managers run numbers they already know the answer to. Delivery obligations collide with empty inventories. Deals are struck quietly off-market at prices that will never be published. This is when premiums quietly explode in the shadows. Then comes phase 3, the reopening. When markets open with export restrictions active and arbitrage mathematically impossible, the paper system will try to reprice instantly. Gaps will form, algorithms will chase reality. But price discovery will be chaotic because supply is no longer elastic. Some sellers will simply refuse to offer metal at all. This is also when defaults begin to surface, force majeure notices, cash settlements, delayed deliveries. Not because of fraud, but because the system was built on assumptions that no longer hold. This is how credibility evaporates in a single trading session. The countdown is no longer theoretical. It is operational. This is where we slow down, step back, and extract the lessons that matter, because moments like this are rare and unforgiving. The silver market is not just repricing a metal. It is repricing trust structure and assumptions that have gone unchallenged for decades. The first lesson is simple: paper markets work until they don't. Leverage can suppress prices, smooth volatility, and create the illusion of abundance, but it cannot manufacture physical supply. When a real-world constraint appears, paper collapses inward. What we are watching is not a rally. It is a transfer from promises to possession. The second lesson is about timing and psychology. By the time headlines confirm a crisis, the opportunity has already passed. The smart money moves during disbelief, not consensus. That is why inventory drains, delivery spikes, and premiums matter more than charts. They reveal intent, not narrative. The third lesson is strategic. Silver is no longer just an investment asset. It is a strategic input. Governments, industries, and corporations are treating it that way because energy transition, electronics, and infrastructure depend on it. Assets that are essential and finite do not behave like ordinary commodities. They reprice violently and permanently when supply chains fracture. So what is the rational response? Stay grounded. Avoid panic. Understand that volatility is a symptom, not a signal of failure. Focus on what you can control: education, risk management, and alignment with reality rather than screens. Do not confuse temporary price swings with long-term value. We are standing at the edge of a reset. The numbers will adjust. The narratives will follow. And when they do, most people will ask how this happened so fast. The truth is, it didn't. It happened quietly, step by step, until the final break. If this analysis helped you see the bigger picture, make sure you like, subscribe, and share this with someone who still believes the spot price tells the whole story. Leave a comment below and let me know how you're positioning for what comes next. Stay alert, stay ahead, and I'll see you on the other side of the repricing.